Incentive stock options, non-qualified stock options. Two types of employee stock options. Both have different grant, tax, and exercise implications. This is just going to be a very basic overview of the two. These are the key takeaways that you need to understand about ISOs, incentive stock options, or sometimes referred to as ISOs, and non-qualified options, sometimes referred to as NSOs. Essentially, with incentive stock options, the key idea is there is a big tax implication. And in this case, it's a positive tax implication for the person receiving those options. Essentially, these options don't qualify as ordinary income. The reason being that if you've had the options for 2 years, which is very common because most vesting schedules are either 3 or 4 years long, if it's been 2 years from the date of grant and you've held the options for at least 1 year, then any profits you make from selling those options are taxed at long-term capital gains rates. They are not taxed at your personal income rate, which would be higher. So that's a big advantage. It's not ordinary income for the person who receives the options. It's long-term capital gains, again, assuming that it's 2 years from grant and you've held the stock for a year. So there are some conditions on when you can hand these out. Otherwise, everybody would hand them out all the time, with one exception, which we'll talk about in a second. The first is that you must be an employee of the corporation. You can't give these to people who are not employees. Also, you have to exercise these options less than 3 months after the termination of your employment. So if you're fired or if you quit, if you leave the company, you have to exercise, meaning buy the stock within 3 months of you leaving. Also, the price of these options must be the value of the stock at grant. You can't just have a $100 per share stock price and hand out incentive stock options that are priced at $5 a share, thereby creating $95 of profit. You can't do that. Whenever you hand out one of these options, whenever you issue one of these options, they have to be issued at the price, which is the value of the stock at the date of the grant. And then also, you can't own more than 10% of the company. Otherwise, you could hand out enormous chunks of companies using this methodology and have really good tax implications. So you can only hand out up to 10% of the company to one individual. So, incentive stock options, not ordinary income. Most important thing, if you remember nothing else, remember not ordinary income, long-term capital gains, if you do things correctly. Alright, so now let's talk about non-qualified options. These are a different type of option that a corporation can elect to hand out. This actually results in, is the opposite. It results in additional taxable income to the recipient. Again, that only happens at exercise. So if you go to exercise your options, the taxable amount is the market value of your shares that you're selling minus whatever your exercise price was. So, if the stock is worth $100 on the open market and your exercise price was $50, you're going to have $50 of taxable income. And that's not long-term capital gains, it's taxed as actual income. So that can be a stinger. The reason companies do this often has to do with the fact that the company is allowed to deduct on their taxes the equal amount of profit that you have gained. So if you gained $100,000 of profit, the company can deduct $100,000 from their own tax liabilities. So it's attractive to the company. So remember, incentive stock options, ISOs, ordinary income, not ordinary income, it can be taxed as long-term capital gains. Non-qualified options are, you're going to end up with ordinary income.